Facebook Live event from PHLV Radio.
Okay.
This is your Filipino radio experience in Las Vegas. PHLV Radio. PHLV Radio.
Hello once again, everyone. Welcome to Buhay Bahayan. How are you guys doing? My name is Francis, and I'm here with my co-host, Miss Mia Casino. How are you, Miss Mia? Long time no see.
Hi everyone, welcome to Buhay Bahayan. My name is Mia Martin Casino.
Are you in Paris? It seems very smoky outside. Oh, don't fall down. Seems like you're in Paris and it's very smoky outside, just like
I know, sorry.
Las Vegas, right?
It's very, very smoky outside. I'm trying to stay indoors.
Yeah, we have a lot of wildfires out there, in California and Nevada as well. So stay safe, everyone. All right, we have a very
allergies.
Yeah, that's true too. So, all right, we have an very interesting topic here. Before that, I would like to introduce our guest. He is the branch manager of Cardinal Financial. And we've known each other for quite a bit. He's a loan officer as well. And so, without further ado, we have Mr. John Obradovich. How are you?
I'm good. How are you guys doing?
Very good, John. Thank you for coming to the show.
Of course.
Mia?
Yes.
Oh, can you hear us?
Yes, I can.
Okay.
I can hear you very well.
All right. Very good. Very good. Yeah, John. So, you've been a loan officer for how long now?
I got in the business in October of 1997.
1997.
I've done loans in 47 of the 50 states.
Wow. 47 of the 50 states. So 3 more to go.
Wow.
Probably not. Those 3 states that were left were a little harder to navigate without being boots on the ground.
Okay.
What are the 3 other states? I'm curious.
I couldn't tell you.
Rhode Island.
Yeah, I'd have to go back. This is going back to my Wells Fargo days.
Oh, okay. All right then.
So like 2008 to 2012, we did. I was at Wells Fargo and we did business all 50 states.
Yeah, I remember. That's where I met John at the private mortgage banking there at Wells Fargo,
Yes.
the executive tower. So. Good to have you here, John. So let's drill down to the topics here. It says navigating debt with John. So let me ask you first and foremost. So can you tell us briefly? I'm sure Mia will have the same question about what's going on. We had Jonathan Chow here last week, and he was talking about real estate on that portion of the current mortgage or real estate conditions. So what are the current market conditions that we've been experiencing? What's going on with the market on the mortgage side?
Yes. So as of April of 23, we kind of peaked at interest rates right around 8%. Since then, we've seen interest rates go down into the low 6s. We've even seen some into the mid and high 5s. So interest rates are on a downward slope, definitely. A lot of this is we're seeing some cooling in the economy, right? So that kind of slows down the economy, which makes interest rates a little better. And then also the Feds are meeting next week, and they will more than likely lower interest rates about 0.25% is what we believe.
Yeah, let me cut you on that. When you say cooling off on the economy, does that mean the inflation is coming down?
Yes.
Okay.
So inflation is starting to, it's already peaked.
Yeah.
And we're starting it to get closer to the 2% target figure that the Federal Reserve wants to see. as that occurs, the economy starts to slow down and less money spent, and therefore they want to re-stimulate the economy by lowering interest rates.
Okay. So, are we in the period wherein no one is, or the interest rates are still so high where no one can afford to buy a house right now? Because based on what I'm experiencing right now is that even though the interest rate, just like what we discussed last week, was that the even with the lower interest rates, it's like people are still so iffy, or if people are hesitant, people are so cautious about, like, I want to buy a house right now, I submit a pre-qualification, but it seems like I don't know, should I wait for after the election? I'm sure me and Mia had the same question last week. So what's your input on that?
So you have a combination of, yes, interest rates have gone lower, but here in Vegas, right? Vegas is a little different than nationally. Nationally, we're seeing some areas of the country where there's as much as 12 months of inventory. Okay. That would very much be a buyer's market.
Right.
Okay. Here in Vegas, we're at about 13 weeks of inventory. So much less. We're much
Seller
more.
still?
A little bit.
Yeah.
It's more
Mix.
balanced.
Yeah.
It's
Okay.
closer to balance. But values of properties have still gone up all this time, right? I think that there's a combinations of reason where we've kind of seen the overall slowing. Number one is debt, and we're going to get into that in a little bit.
Yeah.
Number two is, if we go back to April of 23, which I told you was the peak of interest rates, we still had more buyers and more sales transactions than we do today. I think part of that reason is that there's a psychology to buyers and to sellers and to people in general, where there's the fear of missing out. So even though interest rates are going up, they bought because they were afraid that it's 8, but maybe it goes to 9.
Right.
Well, that same mentality is happening today. So today, because interest rates are going down, they have this fear of missing out in a lower rate or a better financial situation.
Right.
And then you put that with the election that's coming up, everybody's just a little bit on pause. We'll see how we come out of this, but that's how the American people feel right now. Hey, I'm okay.
Yeah.
I'm going to wait.
Yeah.
Let's see how this all shakes out.
Right. But since the economy is getting better, I've seen that the unemployment has mixed figures. Like,
Yes.
are they going up or down? We don't know where that direction is headed. So that for sure, I know, has a lot of a factor, or has a lot of effect on the interest rates as well.
Correct.
So how does that work, or how does that work into that equation?
So there's two questions. First question is, how come there's been what's the correct word? Modification to the numbers of unemployment, because that's what's happening. They report it one way, and then 30 days later, they get the rest of the information, and they find out that they weren't accurate. And so we've been seeing that unemployment has been ticking up.
Yeah.
We're still at historic lows, but there is some cracks around unemployment.
Okay.
Okay. That factors into home buying and home selling. Right? If you don't have a job, or if you're not making as much money in your job, because we just came out of the COVID years where everyone was making bonuses, everyone was making overtime, people were getting higher paid jobs. We had people specifically in the real estate industry where they were one day a bartender, and the very next day they were selling houses and making double, triple the money they were making as a bartender. True.
Now, the main topic is actually navigating with debt. How does debt come into play here with getting approved to buy in buying a house?
Right.
So how does that work? Or if they already have a house, they have a lot of debt, how can they use their house to navigate, or use the equity of their home to manage their debt?
Right.
Yeah. Go ahead.
So when we review a loan for approval, one of the things we're going to look at is what's called DTR, debt to income. And that debt to income, we're going to take anything that's on the credit report, and we're going to add your housing of the house you're either going to buy or refinance. And then we're going to divide that by your gross income per month, and we're going to get a percentage.
Okay.
The percentages can be anywhere from 38% to 60%, and everything in between.
Depending on the type of loan, government, conventional, FHA, or whatever.
And other factors. If you have a 620 credit score,
that's right,
you may not be able to go as high a debt to income as maybe someone that has an 800 credit score.
Right.
All the factors go into the approval process. So that debt that you're carrying may hold you back from buying the home you want to purchase.
Right. So it's still the automated desktop underwriter that determines that. So just for the sake of our viewers, it doesn't have to follow wherein, there is this certain cookie cutter that it's, 45, you don't hit the 45, you're disqualified. If you have a 680 FICO score, 700, it just always depends. So always try to give it a shot, because you may have a 720 FICO score, with a higher debt to income ratio, which you'll still get approved.
Right.
We don't know that. Okay.
If you have a 620 credit score, if you have very little down, if you have very little in reserves, and you have very high debt to income, that's going to be much harder to get approved than someone that's putting 40% down on a purchase, that has a 780 credit score, and maybe has a very low debt to income.
So what would you advise a household, for example? Because nowadays it's I've seen a lot of 2, 3, 4 borrowers applying to buy a house, especially in the Las Vegas market. We're at what, 450, 500s, average median. Mia, what is the average median at this time?
Housing?
Yeah.
450.
450. Okay. So if we have that, if they submit an application and say, we're at like 5%, what would you advise them? Or they got declined because they have, normally that's always the case, is they have a high DTI. How would you approach, or what would you advise them, or what would you advise your clients for that sake? The quickest way. How would you attack that or approach that scenario?
So everyone's different. I love to say there's no silver bullet, right? So if you remember, the silver bullet supposedly can kill anything.
Yes.
We can't treat our clients that way. Every single person's going to have a little bit different scenario. What is important is that you get in front of professionals that can help you build a plan. Because it doesn't matter if you're buying a house today or 10 years from now or anywhere in between. You need to understand what it takes and what things can help you. Too often we see clients go and pay off all their credit card debt, which is awesome. That's a very good idea. Then close the accounts. And then have their credit score actually dive, go lower, and now have no more money for a down payment. So it's not as simple as always do this or always do that. We really need to sit down with them and help build a very fiscal, responsible plan on how they're going to buy a home and how they can get out of debt.
Yeah, as a mortgage expert, that's actually very good, because you don't just advise one thing to do, because otherwise, if you don't guide them enough, wherein, you told me that, I'm supposed to pay off my debt, and now I paid off my debt, but you didn't tell me not to close my accounts, which is, sometimes they sometimes just leave off, although you did tell them, but, now you didn't hold their hand properly, and then now it's just more trouble. So, Mia, did you have a question?
No, I'm always faced with, when my clients ask me about interest rates, that's always a block for them to be able to apply for a mortgage. What do you tell them to convince them to apply for a loan? If interest rate is the only thing that's holding them back.
I don't think that interest rate or median home price or not able to find the home they want should be keeping them back from building that financial plan. How do we buy a house? What does it take? If I were to have a heart attack and I was put on the operating table, at that point in time, I wouldn't want to have my surgeon discuss my diet with me. Right now, I need you to save my life. And once we come out of that, then we can discuss the facts of how I become more healthy. But how much better would it be if you were talking to your doctor years in advance? Many people don't know, but I've lost 100 pounds. And it's something I'm very passionate about is health, because I have family members now that are older, my generation above us, that didn't necessarily take the steps necessary to keep them to live healthy into their 80s and 90s. We need to be proactive. I always say to a client, I don't care if you buy a house today, I just want to help you. You buy the house when it makes sense. And that sense might be a lower interest rate, Mia, to your point. It might be a different area. Maybe you're waiting for a certain type of house. Maybe you're looking for a single family that's single story with 2 en-suites so you can move your family member in. Whatever the situation, we need to help you. And again, we can't treat everybody the same as far as the same plan. The plan needs to be specific to them and helpful.
Very good, very good. I have a segue into, so say for instance they got into that high interest rate before. Now they're a homeowner, and now a lot of people are always questioning, oh man, the interest rates have gone down, and I've gotten into an 8 or 9% interest rate. Now I'm a homeowner, and everybody thinks I'm paying too much, and I still can't afford it. But what are my options? In that sense, say, should I refinance right now, or what should I do?
So we'll do an analysis actually on their overall credit situation. That we're going to look at their personal debt, like credit cards, car loans. One thing that we've seen a huge spike in is what's called buy now, pay later. That's up over 3,000%. So those are those, like you walk into a furniture store and they say, hey, buy today and no payments for 12 months, 0%. Right? We've seen a huge spike in that. And so those are on your credits. And there's a hammer coming if you don't pay it off in the time, because then they'll actually charge you for all the interest going back.
Right.
So we're going to look at their overall scenario and see if there's something that we can do that's going to financially help them.
Yeah.
The good news is out of the '08 crash, right, came laws to where we can't just refinance someone for the sake of making money. We have to help them financially. So we'll look at the overall situation. Do they have any other debt? How much equity do they have? Do they have mortgage insurance? And maybe can we remove that mortgage insurance? Maybe they were put into an FHA loan and now it's time for a conventional loan. So there's many factors that go into it, but we should be doing an analysis of their credit to see how we can help them.
Okay. So what other solutions are there? Since we have forbearance as one of our topics there here, there's forbearance, there's HELOC. Why don't you dive into those? Are those options for majority of our borrowers or majority of homeowners? Would that be the right fit for them? Let's start with the forbearance. What is forbearance?
Okay, so forbearance is not a new thing. A lot of people heard about it during COVID. But if you look at like student loans, you could go into forbearance, right? If you're not able to make your payment, you call your creditor and ask for forbearance. There's a process that you go through to get approved. And then during that period of time, they're going to give you to where you don't have to make any payments. And they're going to collect that payment you should have made and add it on, in essence, to the back of the loan. Or maybe they'll ask you for a payment if you have the capacity to make that payment, or they might even modify your loan at that point in time. This is a really good option if you're having trouble making your payments or you're feeling like you're drowning in debt. The important part is always get in front of a professional so they can help guide you through it.
Right.
We want to there are tools and mechanisms in Las Vegas and nationally that can help you in these periods of time.
Right. Now, I have a question from a client here saying, I have credit card debt. Okay. I have a lot of equity in my home. Should I refinance the first, since it's right now it's lower than my credit card debt, or should I get a home equity line of credit? Which one is more beneficial, and how would either one be advantageous to me or disadvantageous?
Yeah. So we have clients that have interest rates that were able to refinance or purchase a home back in, say, 2020 or 2021. And I know of one client that we helped them get an interest rate on a VA loan at 1.75%. That's in essence a very low interest rate, and possibly once you take the tax deduction in play, very little cost. If you have credit card debt and you refinance out of that loan, you're probably going to go into those interest rates in the 5s or 6s and maybe even higher depending on your situation. And that might not be a good idea.
Yeah.
Right? That's not simple to answer because, again, we're going to look at each person individually and help them through.
Right.
But then there's the HELOC or home equity line of credit or a second mortgage equity loan, right? Which is more fixed rate and acts more like your first mortgage. Right. Those interest rates are quite high. Those interest rates are going to be anywhere from 8.5% to possibly 12, 13, 14, 15%. So when we have someone that has a low interest rate, let's just pretend they're at 3%.
Right.
And then they're going to receive a new second mortgage, right? So it means it's in second position. And let's say that interest rate's 8%.
Right.
Okay. We would blend those two rates to become an overall cost of your debt. If that interest rate is lower than a new first mortgage, then we would go the second interest rate route, second mortgage route.
Second mortgage route, yeah.
If that interest rate blended is higher than what you can receive on a first mortgage, then we'd look at possibly redoing that. But we're going to look at other options first, right? How can we help them? A lot of times we see clients pay on their credit cards, maybe where they have 4 or 5 credit cards.
Right.
Okay.
Right.
And they're paying a little extra every month to all the credit cards. Not the best way to pay down debt. Right? There's many factors, and we're not going to go into all those questions that we would ask in a consultation, but we're going to ask, what's your interest rate on those?
Yeah.
And the best way is to make the minimum payments on the higher amounts and then attack the small. And as you pay those off, work up the chain to the higher amount because you can get more bang for your buck.
Right. Because if you just look at it, if you have all those credit card debts and make all minimum payments on all of those, that'll take you another 30 something plus years.
It's quite long,
and it's you're just paying on interest on each one.
Right.
And a lot of times I get this question every single time. As a matter of fact, why would I refinance all my credit card debts and then go back to a 30 years? And it's like they didn't do the calculation, of course, but how would you answer that? Like, I don't want to do my, credit cards here and put it into my mortgage because now it's going to go back 30 years and now I have to pay. It seemed like it would be bigger interest rate because it's 30 years. It's
robbing Peter to pay Paul for sure. I always tell my clients, or I always advise my clients, that just because we saved you $500 a month, $1,000 a month, $1,500, we have clients right now that we're helping, that we are saving those amounts. We have to do something with that money. One option that I think is a great idea is either A, put it in savings. So that $1,500 goes into a savings account that's not easily accessible. I believe that you should have multiple bank accounts in multiple banks. And you should have an emergency fund in one bank, and you should have your vacation fund in another bank. So it's hard to go after that money, right? So if you're building up a savings, and I think you should always have about 12 months of savings that's in your emergency account. And the reason for that, if God forbid something happens, Francis, you have the ability to make your payments without any help for 12 months. And probably you could even stretch it out to 18 or 24 months. The second option is you take the money and actually apply it towards principal on the new mortgage. And we found that you can save 5 to 10 years and pay the loan off faster than the current mortgage you have in some instances. Right. So we got to do something with that money. Can't just be, hey, it's great, I saved $1,500 a month. Now I'm going to go back out and rerun up the credit card debt, go on vacation. Those are bad things. We're also taking time to help them build a budget because budgets are really important when we've seen this type of attitude of using money that they don't have.
Right. You don't want to dig a deeper hole
into
the hole that you already dug.
Yes.
And so you want to fill that up, and sooner or later manage your debt properly instead of a lot of times when people get their tax refund, they should plan plan their debt along with it, instead of, I get this tax refund. It's like fly now, pay later. You know,
Yes.
it's like, no. So, yeah. Mia, do you have a question?
Yes. I get those letters and mails about national debt relief programs. Are those true, or are
Oh, me
those
too.
a month's
So
program?
I wouldn't say that I know all companies. That would be unfair. But the majority
Yeah.
that I've seen are usually marketing campaigns from
Yeah.
mortgage companies or loan companies that want to give you a loan. And those
Right.
loans might be really good to maybe something that's really not good for you. I had a client come in my office and they had taken out a loan. They thought it was one interest rate, but when they signed the paperwork, it turned out to be 29% on this loan with $5,000 in costs for a $35,000 loan.
Wow.
That's not a good loan, in my opinion. Maybe you need it, maybe you don't. I don't know. We don't want to see you get into a worse situation, Francis, like you talked
Yeah.
about. We don't want to see you dig a hole. We want to see you fill that hole and build a mountain. Build a mountain of savings and go towards your future.
So right now, to the people, like, you know, especially your clients, Mia, with those who have purchased a home within the last couple of years, and now they have equity, but they've also racked up debt. So home equity line would be a much better possible way to get that done for them. To be able to improve their debt situation. Yeah, because I think the home equity line right now, it doesn't even cost. It has closing costs. It has annual fees as well, right? Depending on whichever bank you pick. But it has the least amount of cost, and it works just like a credit card, but it's attached to your mortgage.
Correct.
And it's a tax advantage as well.
It can be.
Can be, yeah.
Yes, can be, depending on the situation.
Yeah.
Always.
But John mentioned earlier the interest rate for HELOC is a little higher.
They can be from anywhere from 8 to 15, 16%.
True.
And everything in between.
True, but then, if you look at your credit cards, they're about, 20, 24?
I've been seeing a lot of 29s.
So that's like double or even triple compared to what your
100%.
Your HELOC would be, and it's much more efficient, more cost-effective way, rather than But I would always say, talk to a mortgage expert like John Abradovich here from Cardinal Financial. If ever you have any questions regarding that. So what else do we have? I think we're running out of time here. I think it's
One more.
one more. Go ahead.
Debt consolidation.
Yeah, go ahead.
Debt consolidation.
Okay. What's your question, Mia?
What is it?
What is debt consolidation?
Yeah,
Oh,
for
yeah,
the
yeah.
benefit of viewers and listeners.
So debt consolidation can be many things. That's a broad word, a broad statement that's used quite often across the board. So you might have debt consolidation where maybe you contact the credit card companies and ask them to consolidate your finances and have where you make payments across the board. Then there are companies out there that will go to the credit card companies for you, negotiate a settlement of your credit cards, and then you pay them monthly and then they pay them. And so you're going to be paying a fee for that. Then you might do debt consolidation through a home equity line of credit or a HELOC like you talked about, Francis. That would be debt consolidation. Or maybe you redo a new first mortgage, or maybe you have a scenario to where you can go get a line of credit that's not tied to your home and get a low interest personal line of credit.
Mia, I think I'm not sure if Mia is asking about. I think what Mia is asking is the what is it? Credit counseling or credit consolidation? Is that what you're asking?
That was the second one, right? So that's where the company goes and negotiates a settlement with your credit card companies, and then you pay them each month, and then they're going to pay the credit cards.
Oh, okay. Just a follow-up question on that.
Party company.
Yeah. Does because I've heard many times that it hurts your credit. Does it really?
It can.
Mm-hmm.
So 35% of your credit score is based upon your history. Okay. So that history is going to be, have you made a payment on time? How long have you had credit? And then also, have you ever settled any credit for less than owed? Okay. And so a lot of these consolidation companies are going to settle, negotiate a settlement with that credit card company for less than what you owe.
That is why. Okay.
So it might be better than the alternative of going bankruptcy, right, or just not paying at all and having a judgment.
Right.
There's different levels of affecting your credit in a negative way. It doesn't mean it's 100% bad.
Right.
And as we go through the days that come, the worst thing you can do is do nothing. Okay. The worst thing you can do is stop making your payments and not have a plan and ignore it. That's the worst thing you can do. The best thing you can do is pick up the phone, talk to somebody, talk to the credit card companies. Now, mind you, they just want to be paid, and that's okay. But talk to professionals, whether it's bankruptcy attorneys, loan consultants, mortgage consultants, loan officers such as myself, whoever it may be, and get some good information. Ignoring is the worst, because once you cross that line of stop making payments, at some point in time, you become difficult to get approved for a loan that's going to be beneficial for you.
All right, very good.
Companies that claim to help clients with their credit.
There are clients, I don't personally believe in them, but that's my personal opinion. I have some clients that say they're the greatest thing since sliced bread, and I have some clients that say they're crooks and they should be put in jail, and everything in between. The loopholes they're using sometimes work effectively and sometimes don't. I think it's better that you get in front of a loan officer that understands credit and understands how to help your credit score. We have simulators at Cardinal Financial, and most mortgage companies and loan companies have simulators to where we can put your credit into the simulator and give it what if scenarios, and it'll tell us how much it's going to help your credit. So we have clients that come and are not quite ready to refinance because yes, they can afford it, but maybe their credit has taken enough hit to where they're not going to get the interest rate they're looking for. And so we help them through these credit simulators and help them develop a plan of how they're going to get their credit to a higher bucket. So credit's done in 20-point buckets. So the mortgage industry uses an 850 credit model. A lot of times we get clients that say, John, I don't understand why my credit score is lower with you. And Credit Karma shows that I have a 750 credit score. Well, Credit Karma uses a 950 credit model. So right there, you can see how it's different. And it's supposed to be close, but we've seen it all over the board. We've seen it low, we've seen it high, we've seen it dead on accurate. But if you have a 740 credit score, so 740 to 760 is going to be treated as one. And then from 740 to 720 is the next bucket, and so on and so on, 20-point increments. So if we run your credit and you have a 617 credit score, well, maybe if we got you to 620, it's going to help you. Or maybe if we got you to 640, it's going to help you. And we know exactly how far we can take you and show you the options that are available for you at each one of those credit factors.
Wow, that's a lot of information, but I don't mean to cut everyone off here. We are running out of precious time. So I think there's a lot of interesting facts and still a lot of information. We cannot just have just one session. I think we might have a part 2 for this because, let's go proceed with our joke time really quick. And so we can end our this segment. So, all right, let's go ahead with joke time. Let's start with you, John. What is your joke?
Okay, why is Tigger always in the bathroom?
Why is Tigger always in the bathroom? Mia, do you have an answer for that?
Why?
He's looking for poo.
Okay. Should I go next, Mia? Do you have a joke?
I have a bear joke.
Bear joke. Oh, wow. Okay. Go ahead.
Of all bears, which is the most condescending?
Of all bears, which is the most condescending?
No idea.
The black bear.
Nope.
The brown bear.
Nope.
The white bear.
It's going to be something like teddy bear.
Teddy bear.
No.
The wild bear.
It's Panda.
Oh, wow. Okay. I didn't know panda was a bear, but anyway, my joke is, why don't eggs tell each other jokes? Huh? Why don't eggs tell each other jokes?
They're going to break their yolk?
No. They just crack each other up. All right, folks, that's the end of our show. Thank you so much for watching. You can watch us on Facebook, YouTube, Instagram, and Amazon Fire TV. Listen to us on the PHLV Radio app. Get our podcast on Apple Podcasts, Spotify, and iHeartRadio. I would like to say hi and shout out to Mr. Jordan Guapo Tiburcio. He's a friend of mine from Australia. He's watching. Hello, Jordan. All right, thank you, John. Thank you for hanging out with us.
Thank you, Mia.
We really appreciate your time. Thank you so much. Goodbye. See you till next time. Bye-bye. Magandang buhay. Bye-bye. Thank you.